All right, let's dive right into this explainer. We're looking at a massive, and I mean massive, shift in the markets today. We've got this perfect storm brewing where geopolitical shocks are colliding head-on with some highly anticipated corporate earnings. Right now, we're seeing tech giants rapidly decoupling from the broader market, crude oil prices are surging, and U.S. Treasury yields are spiking. It is, frankly, a completely chaotic trading environment with a whole lot to untangle, so let's just jump right in. Here is our roadmap for today. We'll start with 1, the macro market shock. Move on to 2, bond yields and volatility. Then 3, the mega cap tech slump. 4, the AI infrastructure divide. 5, winners in traditional sectors. And we'll wrap it all up with 6, navigating market volatility. Okay, section 1, the macro market shock. So it all kicked off with this incredible domino effect across the global indices. It started early this morning. Houthi militants attacked 2 Saudi tankers in the Red Sea. Now, by midday, this localized conflict blew up into some serious market fears about crude oil supply disruptions, and boom, oil prices surged. Then, by the afternoon, the broader market started rapidly pricing in the long-term inflation risks of those expensive energy costs. It was this rapid-fire chain reaction that totally flipped market sentiment in a matter of hours. Crazy, right? Which brings us to section 2, bond yields and volatility. Because of those intense inflation fears we just talked about, the 10-year U.S. Treasury yield shot up toward 4.7%. The market rapidly repriced everything, bracing for a higher-for-longer interest rate environment. And look, this isn't just about external geopolitical pressures, it's heavily driven by hard, undeniable inflation data. Because of that, the chances of the Fed taking a more hawkish stance have absolutely gone up. Those rate cuts everybody was crossing their fingers for, they might be pushed way further down the road. But here's where it gets really interesting. Despite the drop in bond prices, institutions like BlackRock are actually taking a contrarian, bullish stance on U.S. Treasuries. They're arguing that these high yields basically create a massive safety buffer. Think about it. Even if bond prices keep falling, you can rely on that high interest income to offset your capital losses. Meanwhile, it looks like the Fed is going to hold rates steady in July and September. Plus, if yields keep spiking aggressively, we might even see some political intervention to push them back down and keep things stabilized. Now, all this uncertainty obviously messed with volatility. We saw the VIX actually spike above 20 intraday as big institutions rushed in to buy short-term insurance to protect their portfolios. But check this out. By the close, it settled right back down below 20. That resilience is absolutely crucial. It tells us capital hasn't fully fled risk assets just yet. That said, expect volatility to stay pretty high through the rest of the month as the market digests the upcoming FOMC meetings and, of course, the big mega-cap tech earnings. All right, on to section 3, the mega-cap tech slump. So who were the biggest victims of this market shock? The mega-cap tech giants. And the main culprit here? The sheer heavy toll of AI capital expenditures. Google and Tesla both announced massive bumps in their AI spending, and the market instantly punished them. Stocks plunged. Google, which we usually think of as this ultimate cash cow, is spending so much on AI right now that its free cash flow is turning negative. Seriously. Instead of doing their usual stock buybacks, they're actually issuing debt to finance this build-out. Tesla also missed expectations with declining profits. And you know how it goes. When these massive players drop, they drag down other heavy spenders like Meta, Amazon, and Microsoft right along with them. Which leads us to a fascinating dynamic in section 4, the AI infrastructure divide. We're witnessing this strict divide in the market right now, and it's basically a massive wealth transfer happening right inside the tech sector itself. The dynamic is actually surprisingly simple. The companies buying the chips are losing money, and the companies selling the chips are making a killing. The guys spending billions on AI infrastructure, the spenders like Google, Tesla, Meta, and Amazon, they're seeing their stock prices under heavy pressure. But the beneficiaries, the hardware and memory companies like Intel, Micron, and SK Hynix, they're reaping the rewards and seeing impressive stock gains. I absolutely love this quote from the source material. It says, "Google is burning itself to light up the whole semiconductor industry." It just perfectly captures what's going on. These tech giants are basically acting as giant funding mechanisms. They are willingly sacrificing their own short-term cash flow right now to aggressively build the physical foundation that the hardware makers are directly profiting from today. Let's put some numbers to that. Look at Intel's recent earnings. Their Q2 revenue jumped a massive 25% year over year to $16.1 billion. They totally crushed market expectations and returned to solid profitability with an adjusted earnings per share of 42 cents. And their guidance, super optimistic. They're forecasting Q3 revenue between 15.8 and 16.8 billion, which is well above what analysts were guessing. It literally just proves how incredibly lucrative the hardware side of the AI trade is right at this exact moment.
Moving on to Section 5, Winners in Traditional Sectors.
Now, what's really wild is where people found shelter from this tech storm. Despite the 10-year yield nearing 4.7%, the small-cap index ETF IWM held strong. It stayed super steady around its 291 support level. It hasn't even pulled back 5% from its recent highs, though, you'll definitely want to watch its 50-day moving average as a critical support level moving forward. But beyond small caps, we also saw some fascinating stark divergences in cyclical sectors, specifically defense and airlines.
Talk about a tale of two companies. On one hand, you've got Lockheed Martin, which surged over 10%. They reported $20 billion in Q2 revenue, driven heavily by a major corporate tax exemption that basically freed up a mountain of cash for stock buybacks and dividends. On the exact opposite end, American Airlines got crushed. A massive 83% spike in fuel costs, we're talking over $2.1 billion, tanked their earnings per share from 95 cents last year down to a measly 15 cents today. Unsurprisingly, they heavily downgraded their full-year guidance.
Then there's Nokia, proving that traditional sectors can absolutely adapt and thrive. Their overall Q2 profit jumped 18%, and that was largely driven by a jaw-dropping 105% surge in their AI and cloud network sales. But there is a catch. Physical chip shortages are really dragging out their delivery times, so that's kind of capping their ability to see short-term explosive growth, leading them to issue a slightly more modest Q3 sales guidance.
Finally, let's wrap up with Section 6, Navigating Market Volatility.
So what does this all mean for you and your portfolio strategy? Well, in a chaotic, volatile macro environment like this, short-term options are incredibly dangerous. The main takeaway from the source here is to completely avoid 0 days to expiration, or 0 DTE options. Think about it. If Wall Street delays a market move by just 2 or 3 days, those short-term options expire totally worthless, even if your macro thesis was 100% spot on. Instead, use broader ETFs or longer-dated options to give yourself a much-needed time buffer. And honestly, just hold off on heavy, aggressive trading until the market trend clearly stabilizes. To wrap things up, I want to leave you with this one provocative thought. The hardware makers are clearly winning today, no doubt. But when will this massive AI infrastructure build-out finally pay off for the tech giants' bottom lines? Because once this initial phase is done, the free cash flows for these major tech giants are inevitably going to turn positive again. And when that happens, capital is likely going to rotate aggressively out of hardware and pour straight back into the tech giants and AI software apps. The cycle will turn, but remember, we just aren't there yet.